Have you ever wondered why it seems like the lender is always in your business asking you countless questions? Well, come with me and figure out why that is. Thank you, Ms. Joan, for taking time out of your busy schedule to talk to us and answer us some frequently asked questions that a lot of people have for us in the real estate and lending industry, because each lending institution does different things. So we have a few questions that a lot of customers would like to know. Okay. So our first question is, what type of loans do you all offer here?
So we offer pretty much the same as all other lenders. So we're going to always offer FHA, VA, conventional, USDA, the standard conforming loans. In addition to those loans, we will offer some non-conforming loans. And when I say non-conforming, loans that may be bank statement loans, just not the traditional type of financing. We also have some niche products that we're super proud of. One of those being our portfolio loan that requires 5% down, and we have a down payment program that goes with it. In addition to that, we also offer the shared equity program, which allows people to qualify for 25% above the amount that they qualify for, which in this market today helps because people struggle having to not move way out because of the cost of housing in the Nashville area. So that program is pretty popular right now.
So speaking of loan products, what does the documentation or what does the application process look like when you're actually working to get those clients pre-approved?
So we're going to collect up front. We're going to collect things like their pay stubs, bank statements, W-2s, tax returns, and we're going to use all those things to come up with the amount that they qualify for. And it's important that lenders do that because a lot of lenders, a lot of loan officers will look at the credit, pull credit, and qualify them based on what the customer has said. Mm-hmm. Sometimes that doesn't work in their favor because a lot of times customers will list their net income instead of their gross. We qualify on gross, so they're qualifying for less. And so we try to collect all the documents up front to make sure that when we give you all a pre-approval, it's an actual approval based on the amount that they qualify, so you don't get any surprises when you go to write a contract for a client.
That makes sense.
Well, typically, Joan, how long does the approval process take?
The approval process, the upfront approval process, we guarantee 24 to 48 hours to get them pre-approved. And that means pulling credit, looking at their credit, and knowing that we have an application that we can work with. To get an actual approval where it goes to our underwriter, that normally takes up to 72 hours. But it's a very short process. And once a customer is approved and has a contract, we work within the contract date to make sure that they close within that date if it's set 35 days.
So say for instance we have a client that comes to you and they're not approved. Do you have like a process in place where you're following up or provide them with a list of items that they need to help them get prepared to get pre-approved for that loan?
Absolutely, and I'm so glad you asked that question. We have, as of March of 2023, we added what's called a Hope Inside counselor. And that is basically it's not credit repair. It's not credit repair. They're not paying somebody to completely remove things on your credit report. But our Hope Inside counselor works with John Hope Bryant, which is one of the largest financial literacy agencies in the United States, and she basically works to clear things that are not supposed to be on the credit, work with clients on budgeting if that's the issue, helping them to pay off debt, make arrangements and things like that. So I always say we never really have denials because if I have a client that I can't immediately qualify to buy a house, what we typically do is automatically send them to register with our Hope Inside counselor. And the best part about it, there's no cost to them. We absorb the entire cost of the counseling. And so she'll go through the process. They'll register. She'll go through the process. And it has been a success. We've seen credit scores, since she's been here in March, we've seen credit scores go up to 30 to 60 points based on their counseling. So Yeah, we do provide a service. I'm never going to talk to a client and tell them you don't qualify and send them out the door. I always want to give them hope and find a way, a plausible solution to get them in a house. There's so much money for first-time home buyers. There's so much money. And when I teach classes, that's one of the things that I always say is don't let money be the reason that you don't buy a house, because everybody has this preconceived notion that they have to save up 10, 20%, but that's not necessary. It's great to have savings, but it's not necessary. There are programs through the housing fund that we do. There's programs through THDA that we do, down payment programs. The shared equity that I just mentioned is a program. Internally, we have our down payment that goes with our portfolio loan that gives up to $10,000. There's programs through affordable housing that gives $20,000 toward down payment and closing costs. So there is literally money everywhere for first-time home buyers.
What is the difference between a fixed rate and adjustable rate, and do you suggest either or in this market?
Well, there is nothing wrong with an adjustable rate. Let me start there. People automatically back in 2008 when we had the recession, and a lot of it was because people had done adjustable rates and these different type of rates that they didn't understand and they weren't explained properly. An adjustable rate just means that it's fixed for a period of time. It may be 3 years, 5 years, 7 years. After that period, it could adjust 2 points above where it is. So let's say it started at 5, it could, at the first adjustment, if it was a 3-year adjustable rate, it could go to 7. And so you have to be financially prepared for that. And the problem was people were not prepared in the past. We're not doing adjustable rates as much lately, and that's only because the fixed rates were so low, so there was no point in doing an adjustable. The fixed and adjustable were about the same, so it made no sense. So now we are pretty much doing just fixed rates. But the difference is a fixed rate is fixed. It's not going to change. If your payment changes over the course of your loan, that means your taxes or your insurance or something went up, but it's going to stay fixed. An adjustable is going to adjust based on whatever type of adjustable, 3 years, 5 years, or 7 years. But as long as you understand it and you're prepared financially, then it's not.
I think that is all the questions that we have for you today, and we appreciate your time. But let me ask you this: do you have any suggestions or any things that you would like to tell the viewers that might help them in their search for the appropriate lender?
Sure. One, you spend a lot of time with your lender. You spend a lot of time talking, so you want to make sure that you have a lender that understands your financial situation and does not, more importantly, is not just a transaction. Our mission is to help the underbanked and the underserved. So that's what's important to us, is making sure that this is not just a transaction. We're building relationships and we're building financial health and wealth for the future, generational wealth. So as you go through the process looking for a lender, that's what you want to look for, somebody who actually cares about your situation and, is helping you get to the next level. And that's what we consider ourselves.
So what is some advice that you can give the current customer right now, or potential customer, for this market that we're in that has a lot of people a little intimidated? What is some best practices or things that they should think of prior to getting a loan?
Okay, intimidated because of the rate.
Right.
One thing about rates is, sure as they go up, they're going to come back down. Typically, you'll see, a couple years ago we were in the market where there was no inventory. The rates were low, but nobody can find houses because there was no inventory. Now we've kind of flip-flopped, and that's the way it's going to be. That's what I've been doing this 27 years. That's what it's done. Once we get through election and all of, the political things, through some of the recession talk and inflation, the rates are going to come down, and then you simply refinance. Typically, if you've gotten down payment assistance and there's a second mortgage or something, the second mortgage will subordinate their lien, which means you don't always have to pay it off. You can just refinance the first mortgage, get that lower rate, and have a lower payment. So yeah, so no fear. Don't operate in fear would be my advice.
Thank you. Great idea.
And always a pleasure.
Always. Thank you all for having this time with us. I just feel like we needed to debrief and ask some questions because the community wants to know what's going on. And believe you me, I know that you're busy, so it means the world to me that you did this for us today. So.